So, spot Bitcoin ETFs are now trading, but a lot of mystery still surrounds them. Should you buy them? And if so, which fund should you buy? In today's video, we're going to talk about my first impressions with the spot Bitcoin ETFs, how they differ from the previous versions of funds that gave you exposure to Bitcoin, as well as all the good and bad parts of the ETFs in general. Starting with some context, previously there were only two methods in which you could buy exposure to Bitcoin. The first gave you direct ownership of Bitcoin, and that was buying it through an exchange like your Coinbases or your Binances of the world, and of course you could also mine it as well. The problem though that many mainstream investors would actually end up pointing out is that it's hard to safely buy and store crypto on your own. Even with an exchange like Coinbase, you would probably set up a digital wallet via Coinbase, buy the Bitcoin there, and then if you were doing everything properly, you would move it over to a cold wallet, which is held offline. Otherwise, by keeping your Bitcoin on an exchange, while it was convenient, it would make you more susceptible to, say, cyber attacks or perhaps insolvency by the exchange itself. In a cold wallet, however, your crypto is offline and so therefore not susceptible to hackers, as well as the fact that you have your own key to your cold wallet. The analogy there is kind of like putting your valuables in a safe and only you have the key. However, this created a new need. So traditional investors, if they want to buy Bitcoin, they weren't able to buy it in their traditional brokerage accounts. Because the whole process that I just described is extremely difficult. It's not as easy as going to, say, a pension fund and being like, hey, buy this asset by pressing one button. So in stepped the second method to buy exposure to Bitcoin via Grayscale's Bitcoin Trust back in 2013. This allowed traditional investors to get exposure to the price of Bitcoin, but it is important to note that the Grayscale Bitcoin Trust was a private placement closed-end fund which functioned very differently from an ETF. The fund would hold Bitcoins, track the price of Bitcoin, and allowed investors to buy shares in the fund itself. However, investors did not have direct ownership of Bitcoin. On top of this, Grayscale charged a 2% expense ratio, so that's the annual fee for this product, and because it wasn't an exchange-traded fund, oftentimes the net asset value would differ from the actual price of Bitcoin. Here's a chart from 2021 which shows the return of GBTC versus Bitcoin. You can see that it started to diverge quite heavily, and the trust traded at a near record discount to its underlying Bitcoin holdings in 2023. So if you're looking at this from a pension fund or institution point of view, it's a big hassle to buy Bitcoin. And in addition, even if you buy the Bitcoin trust that's available at that time, it's not like you're tracking the price of Bitcoin one-to-one. That is until these days, where the spot ETFs for Bitcoin are now approved. A spot ETF gives you as close to a one-to-one price of Bitcoin as possible. By buying shares that ETF, your ownership represents the direct ownership interest of the physical Bitcoins held by that fund. Now, in a little bit, I'm going to explain exactly what that means and how some of the funds don't actually hold Bitcoins themselves. They actually trust somebody else to do it, which could be a risk. Now, what I think is interesting is that institutional investors, they don't really care about being real crypto investors. They don't want to keep track of private keys or spend time understanding blockchain technology, but what they do want is something that is SEC approved that they can add to their portfolio, which is a hedge against all the other things that they might have in their portfolio. If your interest in cryptocurrency is the decentralized future of finance, well, this ETF is not exactly that. However, if your interest in crypto is, I like this number, I hope it goes up, then this ETF could be for you. Now, personally, I like Bitcoin for its initial purpose, which was the fact that nobody could take it away from you and that you didn't have to rely on any third party like a bank in order to send your Bitcoins from one part of the world to another. Now, compare Bitcoin, which is something that you can own, to your house, which is another possession of yours. Well, technically the house could still be seized by the government if you don't pay your property taxes on time. Bitcoin, in my opinion, was always a decentralized currency, and since no single entity owned it, I really liked it for that reason. So the basic gist so far is this: if you want Bitcoin for the independence that it gives you and to own it yourself, you may want to buy it on an exchange yourself and then store it offline. But if you just want to keep track of the price in your portfolio and have it move along with the actual price of Bitcoin, then this ETF is probably a perfect fit. Now, there are a lot of pros and cons of the new spot Bitcoin ETFs, as well as risks that aren't really being talked about. The first pro that I see with the spot Bitcoin ETFs actually being released and approved and now trading is the fact of institutional adoption. If you care about the price of Bitcoin going up, then these spot ETFs are going to be a new opportunity for institutions and pension funds to put money into Bitcoin, and hopefully that price goes up. The second pro is market stability for Bitcoin, because these institutions might put, let's say, 1 to 5% of their total portfolio into Bitcoin, and since they aren't really day trading these every single day, then what you're going gonna see is that the market volatility for the price of Bitcoin might actually go down. The third pro I see here is that the regulatory approval actually gives confidence to 401k plans, 403b plans, and maybe HSA plans to start offering Bitcoin ETFs as part of their offerings. Let's talk about the cons though, because I think there are a lot of cons when it comes to investing in a spot Bitcoin ETF. The first con that I see that is really obvious is that Bitcoin was meant to be decentralized, and guess what? Now it's centralized. The second is that it's technically still not your cryptocurrency. You buying the shares of the ETF means that the shares of the ETF actually own the Bitcoin itself, so you indirectly own the Bitcoin. So at the end of the day, it's not your keys, not your crypto. The third con I see here are management fees. So a lot of these ETF funds, they have an expense ratio of anywhere from 0.2% to 1.5% per year in order to maintain and have these ETFs as part of your portfolio. Now, if you buy Bitcoin on an exchange like Coinbase, you might pay a one-time fee, but that doesn't mean you pay recurring annual fees. The fourth con I see with these Bitcoin ETFs so far is counterparty risk. So what do I mean by that? A lot of these ETFs hold their Bitcoin with a custodian. If that custodian happens to go bankrupt, insolvent, or maybe even hacked, you lose all of your assets and you are generally not protected. And as of recent, as you may know, this is not an actually uncommon occurrence. For example, FTX completely collapsed about 2 years ago, and Mt. Gox famously got hacked back in the 2010s. Let's actually take a look at the prospectus from BlackRock's Bitcoin ETF, and on page 35, it says the following. Quote, in the event of an insolvency or bankruptcy of the prime execution agent or the Bitcoin custodian, blah, 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 customers, including the trust, may be at risk of being treated as general unsecured creditors of such entities and subject to the risk of total loss or markdowns on value of such assets. Now, this whole paragraph has a lot of jargon, so what I did was I just took the whole paragraph and copy pasted it into ChatGPT, and it actually simplified it for us. ChatGPT says, quote, being an unsecured creditor in a bankruptcy situation means that you are not given priority and there's a risk of losing some or all of your assets. So that means with some of the ETFs today, you have some risk, not only with the ETF itself, but also the custodian. And so it's a question of, do you want to add this counterparty risk to your portfolio? For example, 7 of the 11 ETFs that we're going to talk about today use Coinbase as their custodian. Now, is that actually a risk? Do we actually think that Coinbase could go under or get hacked? Realistically, I think the chances are pretty low that Coinbase gets hacked, goes bankrupt, or is insolvent because it's so heavily scrutinized and it's one of the most regulated exchanges on the planet. So even though that risk can be super low, I think it still adds a layer of unnecessary risk, especially if your objective is just to simply own cryptocurrency. Now, some executives from these ETF companies have noted that your Bitcoins will go into a specific wallet or multiple wallets that are not commingled with retailer assets. However, it remains to be seen whether those specific wallets are actually held offline or not. Many of them will claim that they are held offline, but we don't really know. The last con, which I don't think is talked about enough, is what happens if Bitcoin undergoes what's called a fork. In the context of cryptocurrencies, a fork tends to mean that there's a split in the blockchain, often resulting in the creation of a new currency. If that were to happen, if you held the Bitcoin ETF, you do not get that benefit of getting that other currency. So back in 2017, Bitcoin Cash was created, and users that were holding Bitcoin at the time of the fork received an equal amount of Bitcoin Cash. I don't know the whole story about Bitcoin Cash, but the idea here is that if there's ever a fork, you as the ETF holder do not benefit. I don't think this is a real risk, but hey, you never know. All right, so the moment you've been waiting for. If you are interested in buying a spot Bitcoin ETF, which one should you buy? As of right now, since these ETFs have not been trading for a very long time, we're still unsure which one of these ETFs is going to track Bitcoin's price as close to 1-to-1 as possible. Theoretically, it should be as close to 1-to-1 as possible, but the thing is with ETFs, usually there's some variance due to the fund fees, the liquidity of the asset itself, as well as transaction and storage costs. Let's take a look at the first grouping of ETFs, and I've actually grouped these ETFs by their custodian, and the first group that I want to talk about uses Coinbase. So there are 7 ETFs that use Coinbase as their custodian, and that includes ARKs, Bitwises, BlackRocks, Franklin's, Wisdom Trees, Invesco's, and the Valkyrie ETFs. These tickers will be listed on the screen as well as their corresponding expense ratios, which is the annual fee that they charge every single year for you to have their funds within that fund. You can see that the expense ratio varies anywhere between 0.2% to 0.39% per year. And so let's actually compare two investments, one at 0.2% and one at 0.39%, and see what the fee difference is gonna be on our investment. On an investment of $10,000 over the course of 40 years, you may see your total cost of ETF be over $14,000 more in fees if you ever go with the higher expense ratio fund. That means when you're considering this ETF or any ETFs in general, you should always be cognizant of fees because they're gonna eat into your returns. Here's another graph of the impact of fees on a $100,000 portfolio over 20 years. This is actually straight from the SEC.gov website. You can see that every quarter percentage of fees amounts to reducing your portfolio size by about $10,000 in 20 years, which is pretty crazy. Anyway, back to the Coinbase grouping of ETFs. Ideally, they're all going to be doing the same thing, which is just tracking the price of Bitcoin one-to-one. So if you are going to buy one of these ETFs that has custody of their Bitcoins at Coinbase, you might as well go with one that has a lower expense ratio. Now, even if Coinbase is holding the majority of their cryptocurrency and Bitcoins offline, some people still view this as an unnecessary risk to take. If you really want to own crypto yourself and don't mind putting in a little bit of extra work, then I would just start a Coinbase account, buy the Bitcoins in there, and then move it off to a cold wallet. Anyway, back to the ETFs. Next up, we have Hashdex's ticker symbol DeFi ETF. Now, this is actually a Bitcoin futures ETF. A futures contract ETF does not actually directly buy Bitcoins. It actually uses financial derivatives such as futures contracts to get you price exposure to Bitcoin. I just don't think it's a great choice to invest in Bitcoin because one, it's not even investing in the coins themselves. And then number two, the expense ratio of this fund is 0.9%, which is very high. After that ETF, we have the Van Eck Bitcoin ETF, which is ticker symbol HODL. Again, the custodian of the Bitcoins is the issue here, and the custodian that Van Eck actually uses is a company called Gemini. Gemini is a crypto company started by the Winklevoss twins.
Behind us, this is Cameron and Tyler Winklevoss. Of course.
And it's still a private company, as well as the fact that they're currently being sued for their Gemini Earn program. In general, if you're gonna choose an ETF company with a custodian that is not their own, so they're using an outside party, I would probably just lean towards Coinbase's grouping of ETFs because with Gemini, it's still a private company. We don't actually know what goes on behind those closed doors. Now, the last two ETFs on the list actually hold their own Bitcoin, and that's the Grayscale Bitcoin ETF, as well as the Fidelity Bitcoin ETF as well. In the case of Grayscale, it was actually the Grayscale Bitcoin Trust, and they actually converted it to a spot ETF as of January 11th. So now it does track the price of Bitcoin one-to-one. However, their expense ratio is still 1.5% per year. So on one hand, I think it's nice that they own their own Bitcoins and you get rid of that counterparty risk. However, on the other hand, their expense ratio is so high that I just would not even consider investing with them. The best choice, in my opinion, for this entire video is the Fidelity Bitcoin ETF. It has a 0.25% expense ratio, and Fidelity actually opted to create their own custodian, which is called Fidelity Digital Asset Services. So they literally set up their own affiliate subsidiary themselves, and they bought Bitcoin and are storing them offline within that company. And that's what's nice about Fidelity. You're not only buying the fund, but they're also using themselves as the custodian, so you're also getting rid of that counterparty risk there. Fidelity is also one of the biggest brokerage firms in America with $4.5 trillion under management and $11.7 trillion in total assets. It's also been around for 78 years. This is why I think if you are going to buy a Bitcoin ETF in your brokerage account, you might as well stick with Fidelity's FBTC, and that's because the expense ratio is very low at 0.25% per year. There's no additional counterparty risk, plus Fidelity owns all of their own Bitcoins. Again, I think the safest way to buy cryptocurrency and get exposure to Bitcoin is to buy it in a Coinbase exchange or Binance exchange and then move it to a cold wallet where it's stored offline. However, if you are lazy, maybe you have a boomer friend or boomer parent and they just want to own it within their brokerage account, I think FBTC or Fidelity's Bitcoin ETF is the only one I can really get behind. If you are looking for an exchange to buy Bitcoins, I would probably use my link down below to get a Coinbase account and then just simply transfer it off of your Coinbase into a cold wallet. There are so many tutorials on YouTube on how to do this, or if there's enough demand, I can make a video myself. Okay, thanks for being here. I appreciate you watching my first impressions of the Bitcoin ETF, as well as the pros and cons of the ETF itself. Let me know if you have any questions down below. Make sure to subscribe to my channel, and I'll see you guys in the next video. Peace.